Hacking, data, and identity theft are causing devastating problems. Globex Data is the solution for privacy and security in the digital world. Switzerland has the world's strictest privacy laws, and Globex Data's Swiss-hosted platform is outside of big tech with no data mining. Globex Data is now launching in the USA, offering email and messaging privacy and security to all Americans. Globex Data Limited, stock trading symbol SWISF, web address globexdatagroup.com.
The proceeding may contain forward-looking statements which may not be realized.
All right, welcome back, folks. I'm Larry Kudlow. This is the Larry Kudlow Show. We are on wabcradio.com. That's how you live stream us. You can go to the app on your cell phone so you can hear us across the country, around the world, and throughout the solar system. We have a terrific following throughout the solar system. So we're going to do some stock market work and take a look at the economy. Let's see. Dow is up 213 points for the week. A little bit of roller coaster stuff going on. I noticed the VIX index fell yesterday, but it's at 18. It's a little higher than usual. I'm quite interested, and I want to ask our distinguished guests about the 10-year bond rate, which is 1.45%, which is historically incredibly low. But it has been creeping up about 20 or 25 basis points. What's that mean? Gold's going nowhere. 1748, nothing happening there. Crude oil is up to $74. That's up $3 this week. Commodities kind of flat this week. And the expected inflation, the so-called break-evens, the CPI break-evens in the Treasury tips market, no real change, actually a slight drop, but 251 in the 5-year. Take out 35, 40 basis points for the price in the PCE price index, consumer deflator. You're still close to 2% inflation. But inflation is a problem, and it looks like it's a more durable problem. And we heard from the Federal Reserve this week, blah, blah, blah. I have really, frankly, no idea what Jay Powell was telling me. Maybe they're going to taper a little bit towards the end of the year. They're not going to raise rates. Inflation estimates were raised in their new forecasts, but they don't seem to be particularly worried about that. So there. I don't know what any of it means. Economies, well, let's get to our guests. Before I start ranting around here, blathering on, we have Nancy Tengler, Chief Investment Officer, Laffer Tengler Investments. She's the smartest stock market person I know. Nancy Tengler. And Joe Livornia, former chief economist at the White House National Economic Council under Donald Trump, chief economist at Natixis Bank, and my great buddy. So, kids, welcome back, both of you. Actually, Nancy, I'll start with you because I was interested a little bit. The 10-year bond rate has gone to 145. Now, I know it's still a ridiculous number in terms of the last 50 or 60 or 70 years, but it is up about 20-ish, 25 basis points. Does that mean anything to you? Is that telling the Fed that they should be more aggressive in their something or other? Inflation may be a problem. What do you make of that?
Yeah, it's so hard to tell in the short term, Larry. Thanks so much for having me. And by the way, after the intro, I think Joe Livornia is the smartest person that we both know.
Joe Livornia is the smartest guy, but you're the smartest investment person.
Yeah, I think the bond vigilantes may be rearing their heads slightly. I'm with you. There wasn't much new information from the Fed last week, and there's nothing wrong with that, except that I think their policies just are a little bit long in the tooth by not having tapered sooner. Yeah. And inflation, as we've discussed on your show multiple times, is stickier than the Fed really understands. And so I do think that investors are starting to pay attention to that, but it's still all sort of overshadowed by Mr. Magoo's Washington and what we're going to see come out of there. And the market is also paying attention to that. So, I don't have a good short-term answer except to say we expect rates to be closer to 2%, or we had expected rates to be closer to 2% by the end of the year. And, we're retracing some of the decline in prices and run-up in yields that we saw earlier this year.
Joe, reading your reports, you're getting more worried about inflation. Yes, you are. You're getting more worried about, and Jay Powell know about Jay Powell. So I'm reading Nick Timiraeus in the Wall Street Journal. He's their Fed watcher, their Fed reporter, and he's a real smart guy. I know him quite well. And he made a big deal about tapering. But reviewing what Jay Powell really said, I got nothing out of it. I mean, it was like a wet noodle. And I think that if you're staring down the barrel of a gun that has $5.5 trillion plus one for infrastructure, so let's get that we are about to launch a $6.5 trillion program here from Mr. Magoo's Washington. I love that, Nancy. I don't know that there's a direct link between federal spending and inflation, but there's an indirect link through Federal Reserve bond purchases and money creation. And so I think you're right to be a little more concerned about inflation. And I am listening to you, as I always do, and as I always did in the White House. I'm a little worried about that.
Thank you, Larry, and thank you, Nancy. I'm going to do my best to sound semi-intelligent. I am more worried about inflation. I wasn't worried about inflation earlier in the year because of the big supply-side effect of reopening and what that would do to generally moderate price pressures. But I got more nervous, Larry, over the summer because the supply backlogs in particular clearly are lasting a lot longer. We hear that from various industries and companies. And I am worried about this large spending bill, which you're correct, does not directly necessarily create inflation. But if we're looking to spend $1 trillion plus on infrastructure, you're going to need bodies to actually build whatever it is that's going to be built. And you're going to be competing with the private sector in a world where job openings are about 3 million higher than the people who are officially counted as unemployed. So you can get an inflationary impulse, and that does really worry me. And related to that, Larry, is what's happening on the regulatory and tax side, which will slow potential growth, slow the economy's ability to produce the things we want. And even by the administration's own forecast, they see 10-year GDP growth averaging under 10-year GDP growth averaging under 2%. So it's a combination of all those factors that make me much more worried about the inflation outlook than I was just 3 or 4 months ago.
Yeah. Look, putting the budget reconciliation stuff aside just for a moment. I mean, look, Save America, kill the bill. That's easy. But I'm getting cranky about Jay Powell, who is a friend of mine, by the way. But I'm getting cranky because I know he's running for reappointment and so forth. I get that. And in Joe Biden's Washington, I figure Jay should be reappointed because anybody else that they appoint will be much more dovish and easier money if such a thing is possible. So it'll be worse. Plus, they'll appoint somebody who is a massive regulator of the banking system and put the Green New Deal and all that. But I'm getting cranky, Nancy. I mean, he needs to be more decisive. Really? I mean, come on. $6.5 trillion of spending staring him right in the face with a stickier inflation story than a lot of folks thought. Not everybody, but a lot of folks, including myself. So, come on. Can we cut back on the bond purchases? Can we slow down the monetary base? Can we slow down M2, et cetera, et cetera? That's what I'm thinking, Nancy. I'm getting cranky about the Fed.
I've never seen you cranky. I'm with you, though, Larry, because I think the politicization of the Fed is also somewhat troubling for those of us who kind of know the original mandate and have counted on the original mandate. Now we've got climate change and social justice, and I just don't understand that either. And so I think when you step back and you say, okay, many of us think that the Fed's myopic focus on employment at the risk of inflation, which, as Joe mentioned, I mean, supply chain disruption and delivery times are really stretched. Now it's starting to show up in company earnings. So, you look at FedEx recently, which they disappointed on earnings because their labor costs were so much higher and they couldn't find labor, and their input costs were higher energy costs. That's going to trickle through. Last quarter, I think it was 4% of companies mentioned inflation in their calls as a concern or something they were watching or a worry. And this is how it starts. And then we have the inflation expectations from the University of Michigan at, recent highs or definitely recent highs. And it starts to become a problematic equation that's going to be hard to unwind. And the Fed's data-dependent, backward-looking focus is further problematic in my view. So, and then last thing I'll say is I've said it before on your show, but, this focus on employment at the expense of everything else, all the while the federal government was sort of, paying people to stay home, it just seems lopsided and not sustainable. So I'm with you. I think there needs to be much more definitive action at the next meeting.
Yeah, sure. Want to bet?
Well, the bond market will just do it for them.
Well,
right?
That's what I want. I want it. You know what? I think the way out of this, Joe, is I'm going to root for a higher bond rate to signal the Fed. I mean, the curve is steepening. Point number one. The Fed is not. The Fed guys are saying they're not going to raise the target rate for over a year. This strikes me as the wrong approach. I mean, they should be. I don't know. What do you think?
Well,
will the bond market scare them into it, or what?
Well, ultimately, if the Fed was to be aggressive, that's the only way it would happen. The market would force the Fed to move. The problem, Larry, and Nancy was talking about the politicalization of the Fed. I mean, that's eventually sort of to be expected, given the original sin of Ben Bernanke doing QE for as long as he did. And now, as you know, the Fed has bought almost 60% of all net marketable issuance. Of course, D.C. was going to use the Fed effectively as a money printing operation to fund fiscal expansion. The problem, though, right now, Larry, the way I see it, is that you have the Fed that should have been removing the emergency rates when the emergency was largely over. Instead, the Fed was using the pandemic and the evolution of the virus as a factor behind how they're setting policy. They even mentioned it in the statement that the Delta variant was depressing growth. I'm not sure that's fully the case. So the Fed's sort of got a problem because they've got inflation higher. The economy's slowing. They're going to be tightening into a slowing economy. At the same time, they're removing liquidity. They're really kind of stuck in a box. So what they should have done was moved much sooner. They haven't. I'm not sure how it's going to play out. I know you don't want to talk about reconciliation per se, but to me, I'll be much more upbeat if we don't get this bill as it's structured to come through, because that to me will increase potential GDP and help obviate some of the inflation pressures that are right now in the system. So I'm going to punt on the Fed and say, let's see what happens with Washington. To me, that is the focus. And that's ultimately what's going to drive rates next year. And whether we get 2% move in rates, as Nancy suggests could happen, my fear is it will under a plan to increase spending like they're proposing.
Yeah, but you had a great line in there, Joe. Money creation to support fiscal expansion. That's the story.
Yeah, that's the story, absolutely.
That's the story. I mean, inflation is always a monetary phenomenon. You said they're buying 60% of the marketable debt? I didn't know that.
57. Yeah, since the pandemic began, if you look at how much the Treasury issued from March of 2020 through August of 21, it's exactly 57.0% of all net marketable Treasury issuance. That's a staggeringly large number.
Right. I was going to say, don't you think that's a big number?
Massive.
I mean, yeah, so the Fed is right. I like that.
And now the other thing, Larry, the other thing is here's the other thing, which is interesting, is if you get this, even though the deficit will likely be lower this year and next year than last year, it has to because the economy is much healthier, the Treasury's financing needs are going to go up significantly because one of the ways the government's been able to fund itself is to run the Treasury cash balance down by over $1 trillion, almost $1.5 trillion. So we could be in this weird situation where the economy is slowing, Treasury financing needs are actually higher than where they've been. At the same time, the Fed is tapering and backing away from the market, and yet you've got all this supply to digest. I mean, that's the worst combination. You've got inflation pressure, 10-year notes moving to 2%, as Nancy suggested, and the economy really sort of in a bad spot because it's got tighter policy on the monetary side and looser fiscal and tighter regulatory policy on the other side.
So, well, what's Treasury cash position now? Is it low?
It's around $300 billion.
Oh, so that's come down quite a bit.
Right, it's come down from about $1.8 trillion from when Secretary Mnuchin was there. So they funded a lot of their government needs by running that cash balance down. So a combination of the cash balance decline and the Fed buying is the reason why rates have stayed so low, because there's been ironically, very little supply for the market to digest.
Nancy, profits of the mother's milk of stocks and the lifeblood of the economy. Let's see. GDP now from the Atlanta Fed is 3.7 for the third quarter. They've marked it down quite a bit. I think it was 6 or 6.5. What's the profits outlook in your judgment? I mean, that's going to have a big impact on stocks.
Yeah, so I'm not punting either, but I do think that it's important to see what comes out of this bill. I mean, Wall Street analysts are continuing to raise their estimates going into next year, and we're over 220 for the S&P earnings number. But if you look at the bill, and your friend and mine, Dan Clifton, has done some good work on this, it's going to shave about $10 off of S&P earnings. And if that happens and we're going into a slower growth environment, which agree with Joe and you, we are, it's the math and it's also the trend, we're going to have a big fiscal drag. I think potentially. I think that it's going to be a little bit difficult for stocks. But the flip side of that is this massive liquidity. And I saw that Joe tweeted an article I've quoted frequently by Lisa Balfus in Barron's, Can the Fed Ever Really Raise Rates? I mean, the market can, but we do have a Fed that is hamstringed by all of this, as you just said. So I think stocks still have room to run in here. We're focused on long-term, sustainable, secular narratives, and then valuation secondarily, because earnings growth, that's where it's going to come from. And companies like FedEx, which we do own in full disclosure, are going to have trouble because they're dependent on labor and they're dependent on energy, and that's going to squeeze margins, which, by the way, are at historic highs right now, over 17%. So there's still a lot that can go right, but there are definitely mitigating factors, and that's why I think this bill is going to be so important.
But Nancy, stocks have stopped going up.
They have.
Have you noticed?
I have a great statistic for you. No, but the S&P is only off about 4% off its highs, but the average stock this year is down closer to 13%. So we've been getting these rolling corrections under the index, and you've got those 5 FANG names that are 25% of the S&P kind of propping it up. So I do think the average investor's experience has been much different than the index this year, unless, of course, they're indexed like you are.
Well, look at let's see, the Dow's at 34,798. The high in the Dow was 35,600, something like that. We're about 1,000 points below the high. Is that more or less right?
I think that's right.
So I'm just saying it stopped going up, at least for the time being. So something's going on is what I'm suggesting. I'm not sure I have a handle on it because there's a lot of cross currents. I mean, the Fed is still providing lots of cheap money, and the economy is rising, and profits are rising, although I think Wall Street should not be raising their profits estimates. It should not. But the market has stopped rising. I'm just noting that. Joe, Livornia, energy's up. What's going on with that? I didn't really know that. I mean, I kind of looked at my stock sheets in preparation for the show, but crude, West Texas crude is 74.13, and European Brent crude is 78, both up about 3% this week. Is there something going on there in the oil markets?
The U.S. economy, Larry, has still been pretty strong. Even though growth is slowing, it's slowing from a record pace. So that's part of it. I mean, manufacturing has been very robust. If you look at the ISM, and we've been way above 50 for a while, and new orders are up near 60. So that's part of the story. The other issue, Larry, so that's sort of the cyclical story. The economy in the U.S. is still pretty strong. The other issue is more secular, which the Journal highlighted earlier in the week, as people are moving away from, older coal and gas and, petroleum-based energy production. There's been a lot less investment. So you've really not had very much energy investment partly because of COVID and now because of the regulatory apparatus, such that we're going to probably be in a world where you've got much higher prices relative to any given level of demand than we had in the past, because these newer technologies, some of which are good, some of which I'm a little bit so-so on, aren't necessarily reliable, and they're certainly not necessarily cost-effective, at least not yet. So that's part of the story. And I'll tell you, Larry, coming back to your earlier point about energy, or rather inflation, if you've got supply backlogs, Nancy was talking about labor costs going up, and then you've got energy prices remaining high, and Michigan inflation expectations are trending up toward the higher end of the range. To me, the market is making a very tough bet that inflation is going to stay low. So if energy stays higher, that will continue to weigh on the outlook for inflation, and I think ultimately lead to a much higher inflation risk premium.
Well, those dopes in the Biden administration throwing a wet blanket over fossil fuel production. And there's no substitution for renewables. I mean, come on, renewables are 2.5% or 3% of total power. It's a nothingheimer, and it's not going to change. I don't care how many damn subsidies they put in. It's not going to change. And so if economy grows at 3.5% or 4%, which is historically a good number, strong number, in other words, demand for power is going up, and the dopey-dopes are stopping the supply of power. So that's an issue, Nancy. I mean, it's kind of like a sleeper issue, but it's an issue. The Baker Hughes rig count is not snapping back the way it should. And you know why. These oil companies, I mean, you saw Shell sold its Permian Basin stuff to Chevron, Conoco. I guess. Oh, no, Conoco. Yeah. ConocoPhillips, right. So, that's a leading indicator. They're getting out of the business. That's going to.
And so are a lot of the miners, that had oil and gas exposure. And meanwhile, over in Europe, you have natural gas hitting ridiculous levels, and fertilizer plants shutting down because, they can't pay the energy costs, and that ripples through the economy as well. So now the farmers over there have, higher costs for fertilizer. It's also scarce. They've got other higher input costs. And our natural gas prices have gone up dramatically. And as Joe mentioned earlier, the investment is not being made in adding to supply. It's being made by the companies in paying back to improving their balance sheets and paying back to shareholders. So you have this virtuous, not unvirtuous cycle of lack of supply. And then we've talked before about the whole issue with copper. I mean, I think this has been an interesting opportunity to get into some of the miners as China pulled back their purchases because they were using reserves, and instead so you have an opportunity to get in cheaper because there is no new supply thanks to the environmentalists, and we're going to see increased demands if we push this green energy agenda. So it makes no sense. It's what happens when governments get involved, and it sounds a lot to me like centralized planning gone amok.
They're not environmentalists. I'm sorry. They're not environmentalists. They're crazy-ass, left-wing, crazy people, global warming religionists. A good environmentalist, a good environmentalist is a conservationist, and a good environmentalist knows that our energy base should be expanding, not contracting. We should be all of the above. These crazy people want none of the above.
Well, and try to charge your Tesla in a rolling blackout.
Yeah, that's a great point. That's a great point.
Move to California.
Of course, that gets me to you could be making $800,000 a year and still get $12,500 in subsidies to buy a Tesla. But don't get me started on that. But I will say this, kids. I will say this. The dollar is firm, and gold is going nowhere on the inflation front, Joe Livornia. The dollar is firm, and gold is going nowhere. Now, those are two, market price indicators of future inflation.
No, that's true, Larry. You're right. But, again, there is enough inflation risk out there that I think we have to be worried about it, and rates are low. They've come up from about a low of 112 on the 10-year back in August. We're around 145 now. I think we could push up to 175 or so, and then we'll see what happens from there. But you're correct. It's not a horrible environment. But, again, we could, with the wrong policy, make it significantly worse. and the lower income households will disproportionately be hurt. As you had on your show this week, with inflation being the top issue among pollsters, what does that mean? It means a collapse in real wages. As the CEA under President Trump had put forward, the energy policy benefited the least wealthy households, the lowest income households, by giving effectively a tax cut and an increase in living standards. That will reverse if these energy prices stay high, because it keeps inflation elevated and they've got less purchasing power to spend on life's necessities.
You miss the White House, Joe?
Not if I was there now, no, but I do miss it if I could go back.
That's great. True confessions by Joe. You know, Nancy, you're right. He's a smart guy. There's no question about it. He's a really smart guy, and he's a good guy. And so are you, Nancy Tengler. Nancy Tengler and Joe Livornia, I got a break. You're both wonderful. Thanks for coming on. Appreciate it. Folks, stay with us. We're going to take a short break, and then we're going to do money and politics with Steve Moore and Liz Peek. I'm Kudlow. We'll be right back.